way, if you haven't discovered yet, we do have a cash bar. So if you want a glass of wine or some water now or after Steve finishes, go and help yourself. Partially why we didn't invite too many faculty, because CPA would go bankrupt. But that's a whole other matter. But like I said, I have the pleasure of introducing Jim Stanford. Clearly perfunctory, given, as I say, we all know Jim very, very well. And we know, of course, that Jim is a senior economist with the Canadian Auto Workers and founder of the Progressive Economics Forum, of which a number of people here I know are active members. He holds a master's degree in economics from Cambridge University, a doctorate from the New School for Social Research, and in addition to that, he's a popular educator in terms of having a column in the Globe and Mail, and of course we have the pleasure of watching him regularly on the CBC National. In addition to all of those accomplishments, he's a very accomplished author, more accomplished than many academics I know. He is the author of Economics for Everyone. For those of you who are non-economists, it's a great book. I'm not an economist, and I did read it, and it was helped tool me up in terms of my kind of work. In addition to that, he has contributed to, written, the editor of Challenging the Market, The Struggle to Regulate Work and Income, together with Leah Bosco. And of course, many of us will remember the book he wrote back in the 1990s, Paper Boom, Why Real Prosperity Requires a New Approach to Canada's Economy. Again, something that was, looking back on it over 10 years, very, very prophetic. And of course, in addition to that, a whole range of peer-reviewed publications of one type or another. So, anyway, we all knew that to begin with. So with that, I'll turn it over to Jim, who will introduce Dr. Keen.
Thank you very much, Brian, for that very sweet but totally over-the-top introduction. I sort of feel that I should give the speech now. But in fact, of course, we're here to hear Steve Keen give the speech, which is an awesome treat for us in Canada. First of all, my job is to say just a little bit about the sponsors for tonight. The main sponsor of the event is the new Ontario office of the Canadian Centre for Policy Alternatives, or CCPA. Many of you will be familiar with the CCPA's work on the national stage, and in recent years we've been working to establish provincial offices of the CCPA in different parts of Canada that can tap into more provincial, local, municipal, environmental issues and give the progressive movements a bit more of a platform to engage on some of those issues. So there's a blue card on your seats that talks about the formation of the Ontario office of the CCPA. In the next few months, we'll actually be opening an office. In the meantime, we're pulling together our sponsors and our research associates and the other elements that will come together to make the CCPA more visible and more engaged in some of the provincial and sub-provincial policy debates that are going on. If anybody, for example, heard from Tim Hudak yesterday, okay, with this so-called white paper that they issued, where he, in essence, wants to make Ontario a right-to-work state. He is calling for Ontario to become Wisconsin North, in essence, with a ban on the RAND formula and dues checkoff systems that have been the core of our industrial relations system since World War II. And this is very, very serious stuff that would really, again, further transform Ontario from the sort of province that we all want it to be. And the CCPA will be all the more important in order to confront some of those debates in the months ahead. And we hope that, hopefully you're on our email list by RSVPing to the event tonight. Check out the websites and the other membership opportunities on the card. And we look forward to working with all of you as we establish the actual physical office and expand the CCPA's activities in the months and years to come. The second co-sponsor, the one that we have a special debt of thanks to, is the group that bought the free booze. And that is the Progressive Economics Forum, which is the network of progressive or heterodox economists in Canada. I can't promise that we'll have free booze at every single CCPA Ontario event in the future, although I'm sure it would help with the turnout. But it is free tonight, up to 2 glasses of wine per person, I should point out. Beyond that, switch to your, your Coke. So we do want to say thanks to the Progressive Economics Forum, and then the third co-sponsor of tonight's event is the fine Progressive Department of Politics at Ryerson University, where Brian is a member of. So join me please in thanking all 3 of the co-sponsors. Now the main act, let me introduce our speaker. As a heterodox economist in Canada, I have to think that I've just experienced the phenomenon known as manna from heaven. Because we are blessed to have one of the most outstanding and renowned heterodox economists in the world just pop up in Toronto. It's not like we had to organize it, fundraise, and pay his air ticket. He just actually came. And
thank you for that one.
Right. Steve is visiting as a scholar at the Fields Institute, which is an institute for advanced mathematics at the University of Toronto. And you'll understand why he's at the Fields Institute by the time he gets to about slide 22 of his presentation tonight. But technically, normally, Steve is, of course, faculty at the University of Western Sydney in Australia. He can't often be there because he's making a difference all around the world with his work on the dynamics and the consequences of overaccumulation of debt. What debt means to modern neoliberal financialized capitalism, how we've become addicted to it, why it plays such an important role, and helping us understand what's gone so terribly wrong in the financial and global economies in the last years. He was a winner a couple years ago of the first ever Revere Award, which was organized and awarded by the Real World Economics blog for the person in the world who best predicted the global financial meltdown in 2008 and 2009. And he has been telling us that this is going to happen. And sadly, I know, Steve, you take no personal pleasure whatsoever in being proven right, given the enormous human consequences of what's happened. Steve's book, Debunking Economics, is for sale at the front. He'll gladly sign them. I've got a copy of the first edition, well dog-eared. Again, an example of an economist who can write in English and take complicated ideas but make them accessible, and it's an enormously useful resource. I should point out that through the Fields Institute, Steve will be giving another public lecture 1 week from tonight at the Fields Institute, which is on College Street, 222 College Street at 6 p.m. That will be kind of a supplement to the talk tonight for those who are inspired, and I'm sure that you will be. So most of all, thank you very much, Steve, for being here. Thank you very much for what you do. I present Professor Steve Keen from Sydney, Australia.
Jim talked about an over-the-top introduction to him and another equally over-the-top from him to me, so I think that we've had an over-the-top talk, haven't I? Let's see how we do. Hang on a second, this stupid software package I'm trying to record the screen with is being silly because the mode is supposed to be record the entire screen and it's recording the red line you can see there, which is going to totally set up my web. So pardon me, I've got to, software. Okay, discard that. Don't keep the settings. Pardon me, full screen, watch it do the same wrong thing again. Wonders the software, notice that? Okay, record. Now I've got to tell the bugger to shut down, don't save it. Life of a computer person. You know the old saying, to err is human, to really fuck up takes a computer? Let's see, discard the recording, okay, back again, now full screen, I'm finally going to get there. I think I'll leave it on the web, you get away with that on Twitter these days, so I'll try it live. Okay, my overview. Let's go back to the beginning first of all, and I'll start from there. So the question is the debt bubble and what could it mean for Canada? And I'll give a quick overview because if Paul Krugman is in the room, I need to start at this point and have him walk out. Well, let's give it a try anyway. We're in a debt deflation, and that's something which has only ever happened before back in the Great Depression, and it was first noticed as a potential phenomenon of a capitalist economy by Irving Fisher. And to my way of thinking, we'll only get out of the crisis once the debt level's back to normal levels. And normal, I mean, when there's the debt we've got is for good necessary reasons, investment and some consumption, not speculation. And that could be 15 years from now. The reason neoclassical economists who dominate the profession, and I'm doing my best to eradicate them, I think I'm a bit like Max Planck on that, or when it comes to believing whether I can convert people to believe a fallacious theory. Max was talking about physicists who actually are scientists. when he wrote the comment that science progresses one funeral at a time. Now, the reason they didn't see this crisis coming, they leave banks, debt and money out of their models. Now, I know when I say that to a non-economist, the reaction is, huh? You've got to be kidding. You know, they're economists. Of course they know about banks and debt and money. And I say, no, they don't. They left it out of their models, so they couldn't possibly see a crisis caused by debt, banks and money even coming. And I used to, when I tried to explain this to people, I could see people sniggering, you know, I was a lefty. You can't read the math. It must be in there somewhere. Well, Krugman, who does write the math, finally saved me the effort of having to assert this by making this statement in the New York Times, or his blog in the New York Times. He said he always tries to find the simplest representation possible. You ever heard of the KISS principle? It's keep it simple, but not too simple. As simple as it can be, but not too simple, which was Einstein's idea. Make the idea as simple as possible, but no simpler. He goes beyond that point. So you have to go at me and say that I bring a lot of assumptions that I don't explain why they're crucial. And then says, I assert that putting in banks in the story is essential. Nobel Prize winner in economics, people, this is the next line. I'm all for including the banking sector in stories where it's relevant, but why is it so crucial to a story about debt and leverage? I rest my case. I mean, my way, if you actually try to analyse capitalism without including banks, debt and money, it's like trying to explain how birds fly while assuming they don't have wings. Good luck. If anybody takes you seriously as a theory, but unfortunately economists we do. So they believe we can ignore what I'm going to call the red pill, and you'll see why in a moment for those who know your matrix references that's obviously related to that. The red line is the ratio of private debt to GDP. Notice any similarities between now and the Great Depression. The blue line is the one that politicians and neoclassical economists obsess about and say we should be worried about. Massive levels of government debt, which are at the moment running at about 1/3, 1/4 of the level of private debt. So if you take a good look at it, look at the red pill carefully. The only time where we're seeing debt plunge in the way that it's plunging right now was the Great Depression. And the only time we saw it rising at that exponential rate before now was the Roaring '20s. Whereas the Roaring '20s only really lasted for about 5 years, when you take a look at the length of time that bubble went for, ours really began right back in 1945, all the way through. And debt's been growing across that whole period almost exponentially, with a couple of exceptions where it grows super exponentially, all the way through, to the stage where our debt level now is 1.7 times what it was when the Great Depression began. So anybody who's not an economist would look at that and say, there's something to be known about debt. But an economist says, oh no, we can ignore it. Well, what I'm going to tell you tonight is how why you should ignore the economist instead and follow your gut instincts about data like that. Now, of course, that's American data. What's Canada like? Well, thanks to Jim, I managed to find some of this data. I can't see whether the data includes the financial sector's debt to the banking sector. That's an important part of the whole dynamic. That accounts for 120% of the private debt ratio in America. The total ratio to GDP is 300% at its peak, and 120% of that was borrowing by the shadow banking sector from the banks. So I don't know whether this is or is not included in the data I've got for Canada. Hopefully it is included, because if it is, you've got a much smaller debt bubble than America. 170% of GDP. So I can't be sure whether it compares, the data just isn't that good. America gives excellent data, and their economists do an excellent job of ignoring it. Canadians, I'm not certain whether the data includes that particular component, but even without it, you've got a debt bubble, and it has burst. Now, why does debt matter? Well, the way conventional economists think about it is to say that banks lend from reserves, so they have to have reserves before they can lend. And what they're doing is simply connecting savers with borrowers. So they're simply sitting in between us. Matthias might be a responsible character who doesn't spend very much. I'm a profligate so-and-so. I borrow $100 off him. I can spend $100 more, but he's $100 less to spend, therefore it doesn't matter. Therefore you ignore it. That's literally the way they think about it. And again, just to remind you of Paul Krugman's statement. He's all for including banks, in a story where it's irrelevant, but why is it relevant to debt and leverage? Well, let's quote a rampant radical, the Vice President of the New York Fed, in 1969, trying to stop the monetarist experiment led by Milton Friedman. And he talked about monetarism having what he called the naive assumption. Now that's his description. The Vice President of the Fed actually knew the practical ins and outs of how the Fed operated. Is that they have a naive assumption that the banking sector only expands loans after reserves have been put into the system. And he said, in the real world, banks extend credit, creating deposits in the process, and they look for the reserves later. So the reserves are not a control mechanism, they're a residual. And he kept on going about it. This is much more detail in his speech than just that. He said, what the reserves are based on is the level of deposits 2 weeks earlier. So when you know what your deposits are, and you've already created additional loans that expand the deposits, then the reserves are based on what you did 2 weeks ago. So it's not a control mechanism, the reserves run behind. And he said, at the same time, the banks are required, that as a central bank, it's required to make sure that banks can settle the loans with each other. So they've got no choice about the amount of reserves in there. Now, of course, I'm sure you'll all realise that with the advances in computer technology in the last 40 years since that statement was written, the time lag is no longer 2 weeks, it's now a month. Okay. So this is the fallacy that conventional economists like Krugman have that means they ignore the role of debt and banks and money. There's their imagination that is a patient person, cautiously saving, an impatient person's got no money at all, and what happens is a patient person leads to the impatient person. So the patient person's spending power falls, the impatient person's spending power goes up. In the aggregate, there's no particular change. They might have different rates at which they'll spend, but that's all you can bring it down to. And you can ignore the banks, so they just sit there as an intermediary between the two parties. So that's the vision that conventional economists have of banking. The actual process is a bit more like this. An entrepreneur, or these days unfortunately normally a real estate speculator, approaches the bank and says, I've got a great idea, and the bank says, yep, we like that idea, here's $100 million, and by the way, you owe us $100 million. So there's a simultaneous double entry bookkeeping exercise where they create the deposit and they create the debt at the same time. And reserves aren't needed for the process. And here's the most recent statement I could find of it from the European Central Bank. And even though I'm very critical of central banks, I'm finding that quite a few of the research units are almost screaming at the economic profession saying, hello, drop out of the textbooks, come to reality. This is what actually happens, this is what we do. This is the European Central Bank bulletin from last month, saying the reserve requirements depend upon the stock of deposits as they stood in the previous period, and this after the banks have extended the credit demanded by their customers. So they extended credit first, the reserves are created to match that later. In fact, the Repayment Act ends up creating most of the reserves they need. So the new loan puts additional spending power into circulation without reducing the spending power of savers. And therefore, aggregate demand exceeds demand from income alone. This is where I start getting to something which I know isn't just neoclassical economists who don't follow this one. Quite a few of my colleagues in the non-orthodox world don't follow it yet as well. And Matthias and I have done a little mathematical proof of that. Or if anybody asks me, I'll hit you with the mathematics, and you can blame me or blame Jim, whichever you prefer on that. But it's aggregate demand is income plus the change in debt. And that's what's left out of conventional thinking. Now, the reason I saw this stuff, the reason I've been working in this area for so long is I discovered the work of Hyman Minsky back in the late 80s. And Minsky was someone who, in the middle of the biggest boom in capitalism's history, the 1950s and 60s, set himself the question, why did the Great Depression occur? And said, you can't have a valid theory of economics unless you can explain the Great Depression. That was his orientation. Now, he was going completely against the grain of mainstream economics, and this is the sort of treatment he got from the mainstream. Remember, of course, Bernanke is seen as being an expert on the Great Depression. That's why he got the job as Federal Reserve Chairman. His complete discussion of Minsky in his book, Essays on the Great Depression, is that Minsky argued for the inherent instability of the system, but had to depart from the assumption of rational behaviour. He says, I don't deny the possible importance of irrationality, but it seems the best research strategy is to push rationality as far as it will go. That's it. That's 48 words in total on Minsky. in his entire book. So he's not an expert on the Great Depression. He's an expert on explanations of the Great Depression that are consistent with neoclassical theory. And since neoclassical theory says capitalism can't have bad crises, the only thing that can cause a crisis is somebody outside the system, a government regulator, for example, the Federal Reserve. So he blamed the Federal Reserve for doing it, which is why I'm delighted to see him in the hotspot now. I get a certain amount of schadenfreude out of seeing things like this. Now, he's finally been discovered by the neoclassicals, and Krugman and I locked horns over this particular paper of his, which he called the Fisher-Minsky coup approach to debt deflation. But the model he built assumed equilibrium. The DSG, they call them dynamic, stochastic, general equilibrium models. They're neither dynamic nor general. They're stochastic and they believe in equilibrium, but they're neither dynamic nor general. They're put in highfalutin terms that mean nothing. They don't have endogenous money or banks, and aggregate doesn't matter, only the distribution. All that goes completely against the vision Minsky himself had. So Minsky, when he first started devising his theory, said you can't build what I'm talking about in the neoclassical model because they leave out capital assets, they leave out banks and money creation, they leave out what liabilities, financial liabilities do, they forget about uncertainty, they're all assumed away. And that's got worse, not better, since Minsky wrote those words. So he said we have to abandon neoclassical thought rather than build on it. And I was quite happy to do that. So what I did was build on Minsky's ideas. One of the key ones was disequilibrium matters. Neoclassical theory assumes the economy is always in or very near or heading towards equilibrium. But the best argument against it came from somebody who himself was an equilibrium thinker when he wrote Irving Fisher back in the 1920s and 30s. And he wrote the equilibrium theory of interest in finance back in the 1907 to 1930. And then he followed his own instincts, followed his own theory, and got wiped out by the financial crash of the Great Depression. And in that state, when he was really effectively bankrupt, he then reconsidered, in a great deal of pain, why on earth did he get it wrong? And he realised a major reason was because he assumed equilibrium. But he said in the real world, even if you believe the system heads towards equilibrium, because shocks come in at all times, any variable is going to be above or below its ideal equilibrium. Therefore, to model it, you have to take disequilibrium as your starting point. It's not quite as eloquent as Keynes, but a similar idea. It's as absurd to assume that the variables in the economy will stay put in perfect equilibrium as it is to assume the Atlantic Ocean can never be without a wave. So you've got to be disequilibrium to begin with. And Minsky's argument goes beyond that again to say even if you reached equilibrium, that itself would be destabilising. Because a period of tranquil growth in a capitalist economy is the exception, not the norm. And when you get that period of tranquil growth, your reaction is to have rising expectations. So constant, stable growth leads to rising expectations, which means you gamble more and you therefore destabilise the system. And he said this is a beautiful line. The tendency to transform doing well into a speculative investment boom is the basic instability in the capitalist economy. And that again is a vision which transcends most of the left that tends to have a capitalism has to go into depression type attitude or under-consumptionist and so on, or crisis about profitability, the declining rate of profit and all that stuff from cardboard cutout Marxists. This is seeing capitalism having a tendency to get into too much debt, and that causes its dilemmas. And endogenous money is essential because they create spending power out of nothing. Now that's good when it finances investment or behaviour of entrepreneurs. This is coming to Schumpeter, who was Minsky's PhD supervisor. And in talking about how money is provided, he said the conventional argument that a saver gives to a borrower is not obviously absurd. Therefore, it takes a bit of thinking to realise why it is absurd. He said the other way of attaining money is the creation of purchasing power by the banks, which is not transforming existing purchasing power, but creating new purchasing power out of nothing. Now, Schumpeter's economist you should follow. He's truly one of the great economists. But the non-great economists actually end up confirming Schumpeter when they do empirical work. This is Famer and French, who are two of the guilty suspects for foisting the efficient markets hypothesis upon the world. And they did some empirical research at one stage. They looked at the aggregate level of debt for the corporate sector, aggregate retained earnings, etc., and took a close look at it and said it's obvious that changes in the aggregate level of business debt correlate with changes in investment. And they said debt's the residual variable, investment increases debt, and higher earnings tend to reduce it. So debt plays a crucial role in financing the productive investment in the capitalist economy. The bad stuff is where Minsky comes in. It also finances Ponzi schemes, whether the people involved in those know they're in a Ponzi scheme or not. And that's when you have asset prices being driven up by rising levels of leverage. And that's really been the story of the last 40 years in American capitalism and also in Canadian and Australian, basically the whole OECD area. So Minsky's theory actually sounds like a description of reality, and that's what a theory should be, rather than an absurd load of nonsense. But I'll go through it. He talks about an economy in historical time. Now, both history and time are omitted from conventional economic theory. Century and historical. Whoops, I think I've somehow been disconnected there. Is that sound something gone down?
It has gone down, yes.
What happened? Any? Okay, we're back again. Thank you. Okay. Because in historical time there's been a debt-induced recession in the recent past, like the 1990s recession, for example. That means firms and banks are both conservative about the amount of debt they'll take on. Because they're conservative about what they'll consider, only conservative projects are put forward. Because the economy has recovered, most of those projects succeed. And firms start to revise their risk premiums, thinking, hey, if we'd actually been more highly levered, we would have made more money. So you get a rise in the accepted ratio of debt to equity, and off we go into the telecommunications boom and the internet bubble and so on. And assets start to be valued more highly as well. The classic stability is destabilising, as Minsky summarised so well. The period of tranquility causes rising expectations, and for a while that's good because you actually get more investment, and the investment makes the economy grow faster. But you also get to what Minsky calls a euphoric economy. And people in the finance markets in particular start to behave as if they're living on a permanent diet of cocaine. Quite a few of them are. So speculation on assets rises. There's an increased willingness to lend money, and of course that causes the money supply to expand, enabling riskier investments, so there's more loss-making investments going on. You're accumulating losses in the middle of all this process, which is part of the reason why it starts to fall over. And Ponzi financiers turn out. Now, their financiers have a cash flow on their assets, which is less than the debt servicing cost on the assets. So they're technically always insolvent. They make money by selling assets in a rising market, and they must borrow money before they make an asset sale. So they've got an interest rate insensitive demand for finance, which helps push up commercial rates for everybody else. You've had failed ventures as well, accumulating losses, accumulating debt, etc., etc. Ultimately, one of those forces makes a few projects that started off being conservatively funded become speculative. Some of those investors sell their assets in. There's all sorts of triggers that could bring the whole thing undone. But the entry of new sellers into the asset markets floods the asset market, it collapses. It's nowhere near as broad as our obsession about talking about asset prices makes it seem. And as soon as that trend of rising asset prices ends, the Ponzi's are history. They're the first ones to go bankrupt. Because they can't sell assets for profit anymore, nor can they roll over the debt they've currently got. They're gone. My favourite example there was a guy called Christopher Skase, an Australian Ponzi merchant from the late 1980s. He made a takeover bid for MGM. $3 billion. Corcoran, is that his name? Yeah, Corcoran was on the board of MGM, didn't believe this guy, investigated his finances, said, he's a con artist, don't touch him, don't go near it. MGM turned down the takeover bid, so he had $3 billion lined up to buy it, and the next week he went bankrupt because he couldn't pay a $12 million loan instalment. Now if he'd got the $3 billion, he would have bought MGM with $3.2 billion, paid the $12 million out of spare change and kept on going for a bit longer until he would have crashed MGM at some stage. So Corcoran did the world a service by stopping him. But that's how fragile they are. If they don't have the rising debt, they can't get the debt again, they can't sell the asset at a profit, their history. Asset prices collapse, debt to equity ratios plunge, the expansion of the money supply goes into reverse, investment evaporates, you're back where you started again. Now I think you probably all were going through the mental process of filling in the historical blanks yourself as I went through that. So that's the basic pattern, but on top of that, the process will, if you don't have a terminal crisis, the process tends to repeat itself before you've reduced the debt back to where you started from on the previous cycle. And the logic for this is quite simple. Effectively, you're borrowing money during a boom, you have to repay it during a slump. You don't quite get the cash flows you expect to repay it right down to the bottom again, but by the time you start to be flattening out once more, you've got through the crisis and your expectations start with a higher level of debt, which you're now inured to by having survived the previous time. But you do finally get that final crisis where the debt level overwhelms the economy, and that's what we've done this time around. That's why you're seeing a huge plunge rather than just a cycle and a renewal of debt levels going even higher. So I built a model of Minsky working from a cyclical model by a guy called Richard Goodwin, who was produced back in 1967. And I'll take you through some maths here. So this is the slide 23 Jim was talking about. The basic idea that in Goodwin's model is that it's a deterministic model that says a certain amount of capital will determine the amount of output by a relationship that economists call the accelerator. So it's sort of a normal ratio that's given as 3. So you have a capital stock of 1.2 trillion, you'll have GDP of 400 billion. With the output determined, that lets you know how many workers you need to hire given labour productivity. So you divide output by labour productivity and you get how many workers you need to hire. Given your population, it tells you what your employment rate is. And a conventional thing in any economic model, even though the neoclassicals destroyed Keynesian economics by deriding the Phillips curve, is this idea that there's a nonlinear relationship between unemployment and the rate of wage changes. I'm just using a linear one here. They call the Phillips curve. That gives you the rate of change of wages. And if you integrate that, and this is being done numerically, you then get the wage level. Multiply that by employment, you get the wage bill. In this very simple model, there are only 2 social classes, workers and capitalists. Subtract wages from output, you've got profit. Again, in this very simple model, Goodwin had capitalists investing all their profit. So if you invest, that's the rate of change of capital. Integrate that, you've got the capital, and you're back where you started again. And what that gives you is a model of a cyclical economy. That's the sort of stuff I teach my students in day 1. Get them over the belief everything has to reach equilibrium. Yeah, most of them die of a heart attack, but that's okay. The good ones survive. Okay. Now, Goodwin didn't have any role for debt in the model, but you've got to bring in debt to have Minsky. And therefore, it's essential that capitalists wish to invest more than they earn during a boom and less than a slump. And they do. That's exactly what Farmer and French found. So that verbal statement there turns up as an equation like that. The rate of change of debt is going to be investment minus profits. That's looking just at corporate debt now. This is the sort of borrowing you actually want to see, but even that can lead to trouble. So when I ran the model for the very first time, I saw 2 potential behaviours. On the left-hand side, depending on how close you got to the equilibrium, if you started near the equilibrium of the system, you'd see the system converging. That's the red line is cycles and the employment rate, the blue line is cycles and wages share, and clearly the system's converging. But over here it's doing something very different. It's exactly the same model, exactly the same parameters, just different initial conditions. This is what people in the chaos theory talk about sensitivity to initial conditions. What's going on behind those 2 situations is different behaviour in the aggregate level of debt. And the blue line is where debt's rising, the red line is where debt is falling. And what you see is that cyclical process that Minsky spoke about, of debt going through a series of humps until bang, you get the mother of all humps, and it's good night Josephine for the economy. And that's what I read back in 1995. I had the government there as well, which could stabilise the system. What I'm trying to do now is convert that into a strictly monetary model. That's one reason why I'm over here in Canada with Matthias and friends at the Fields Institute. So I've done that, and with that model, this is looking at the stylised data now for America. So I've taken the data for the inflation rate and the employment rate, which neoclassical economists do consider. But the black line is the one they ignore, the ratio of debt to GDP, which they reckon has got no role at all. That's the empirical data smoothed. This is what my model generates as an output. Now I can't get the downturn in debt we're now going through, but that would include bankruptcy, which I haven't yet built into the model. But I think it is stylized fact I've come pretty close to getting the behaviour of the system we've actually seen. And that's sitting, waiting to be published by an author in a journal, what used to be a progressive journal is now a conservative one, and I'm wondering how long the editor's really going to sit on it. I might work on that one, Jim, at some stage in the next few months, we'll see. So, let's try now to bring some, here's the other slide Jim was warning you about. Why do I say income plus change in debt gives you aggregate demand? Well, think about your own spending. If you went shopping, you can either whack it on the MasterCard, which is the debt, or you take your cash out of your pocket, or you use your debit card. So you can either spend from your income or your change in debt. And because of endogenous money, that aggregates. The change of debt doesn't cancel out. If you go shopping now with your credit card and whack $10,000 out to go and buy some very good sports car or a very cheap sports car or a good motorbike. lots of push bikes. Actually, should have a very expensive push bike in the city. It's rather good to see. I wish Sydney was the same. But if you do that, you actually create money and debt at the same time. The banks can't stop you doing that. You can create $10,000 of additional money and debt yourself by doing that. Of course, somebody else gets the money, you get the debt. There's also two categories of supply. You can spend that money on goods and services, or you can go and gamble on a new condo, hoping its price is going to rise. So you either buy goods and services or existing assets, financial claims on existing assets. And Schumpeter argued that income is mainly spent upon consumption, whereas the change in debt mainly finances investment. And Minskian adds in, yes, but it also finances speculation. So I can make this argument saying wages plus profits plus the change in debt is going to be equal to consumption expenditure plus investment plus the new gambling on asset prices, with wages and profits mainly going, distributed profits mainly going to consumption, and the change of debt mainly financing investment and gambling on asset prices. And I call it the Volras-Schumpeter-Minsky law because neoclassical economists work with the Volras law to say that aggregate demand is aggregate supply. And so, well, while I was on the right track, but he left out credit. So Schumpeter and Minsky bring in credit. So I'm giving some, pardon the pun, credit to Volras to include his name there because you do need that sort of accounting balance to understand how a capitalist system works. But this is the balance I work with. And that now brings in a few little tricks, which start to get very hairy. This is the slide Jim will tell you to go get your second drink for. Income plus change in debt, I'm now got equal to GDP plus net turnover in assets. And you can break down asset gambling into the price of assets times the quantity times the fraction of the turnover in a year, which is much less than 100%, of course. And that has implications for both aggregate demand and aggregate economic performance, so employment and output, because the change in debt is going to have a strong relationship to GDP, because that change in debt is what gives you investment that finances growth in GDP. But debt acceleration will also drive both changes in GDP and changes in asset prices. Now I'm doing the second differential, looking at the change of income, and what now turns out is not the change of debt, but the acceleration of debt. And that acceleration of debt is going to be related to change in asset prices. I know that's hairy, but part of the way to think about it, if you want to sustain the current price level of condos, you need a constant flow of people buying them, new mortgages coming in. If you want the prices to rise, that rate of growth of new mortgages has to be rising as well. So you need accelerating debt to drive asset prices up. And that's what's been happening for the last 20 to 30 years. And all this stuff explains both the crisis we've been through and the bust we're going through as well. And because we rely upon accelerating debt for rising asset prices, that's why you have to have a bust in an asset price bubble. It can't go on forever because nothing, not even debt, can accelerate forever. So looking at the level of debt we have now, comparing it to the Great Depression, there are reasons why we're going through a different experience this time around. This is breaking down American debt into business debt, finance sector, and household. And you can see that business debt is lower today than it was back then. Now, what happened back in the 1930s was because it was so high, and banks and firms themselves were in financial difficulty when the slump hit, the response of business people was to cut their prices to try to drag customers in through their door rather than their neighbour, when the neighbour was doing exactly the same thing. So the aggregate level of debt actually fell from 1930 on, but the price level and GDP fell so rapidly that the debt ratio rose. That's why the huge blowout in debt above that level. That's why I also start from the 1930 point for comparing us today to then. But there's much higher household debt this time around. So the response is, rather than businesses having to liquidate or have liquidation sales to avoid bankruptcy themselves, it's their customers that are being liquidated. And businesses are sitting there waiting, why is nobody coming in through the door? So you're getting slow deflation rather than the very rapid deflation of the Great Depression. But the key one is the incredible rise in finance sector debt. It was 20% of GDP at the peak of the Great Depression. It's 120% plus this time round. And that's all been used to gamble on rising asset prices. So you can explain both this crisis and the difference with the last one by focusing on the level of debt. Now, having said that aggregate demand is income plus the change in debt, what I'm doing in these slides is in the red line I've got GDP, the blue and the black line above it are GDP plus change in debt, where the blue line is just the private debt and the black line includes government debt as well. And you can see that the peak level that debt was boosting demand in the Great Depression before the slump began was about 8% of demand is being added to by changing debt, 25% fall in demand down here. The situation we're in today is far more extreme than that. The change in debt in the last big year of the boom for America was $4.5 trillion when the GDP was $14 trillion. So almost 30% of demand came from rising debt. When the slump hit, that fall in debt was $2.5 trillion. So you went from an $18.5 trillion economy down to an $11.5 trillion one in 2 years. That's why it was so severe. This is the sort of stuff that the post-Keynesians can understand because we all follow Minskian. But the neoclassicals can't fathom why it was so bad because, look, it was only a small fall in GDP. They can't comprehend why it was so big, that's why. Nor can they comprehend why it's recovered as much as it has. This is why, because the rate of decline of debt has slowed down from the peak level during the downturn. Now this is now looking at the acceleration of debt and change in employment, so I'm correlating that second order stuff. How much does the acceleration of debt correlate with employment change? Well, that's back in the 1930s, 20s and 30s. Now, this is a correlation coefficient that sustains itself through both boom and bust. So often these things you'll get a great correlation which then collapses when economic circumstances change. This one remains through bust and through boom. What about today? Working with monthly data this time round. Again, you can see the correlation. And you can see just how deep the downturn was this time around. Let's go back on that previous slide. The credit deceleration was far lower in the Great Depression than it was this time round. Far steeper. And you can see the recovery and then now the downturn that's happening again in America, all driven by the ups and downs of the acceleration of credit. And that then drives what you see happening in share markets as well. This is the Dow Jones, deflated by the CPI. So simply divided this Dow Jones by the consumer price index, set the value at 100 at the beginning and gone forward 95 years. And as you can see, there's a trend. So the black line is the trend. There's a good reason to have a trend for rising share prices because some companies don't pay dividends at all, Microsoft, Berkshire Hathaway and so on, and lots of companies also retain earnings and invest the earnings. So there's a reason to expect share prices to rise over time. So I've now, what I've then done is deducted the actual red line, red from the black, and then taken a look at how much that correlates with the acceleration of debt. And that's the relationship back in the Great Depression. Pardon me, a bit too fast. And this is the relationship today. So again, what we're seeing people chase on the stock market, and they think that they're being stock market geniuses, they're riding the ups and downs of the acceleration of debt. Now house prices even more so. This is the American house price index, deflated by the CPI. Going right back to 1890. Work done by Robert Schiller. It's one of the best of the neoclassicals, now going across to being more behaviourist. Now the average from 1980 to 1997 was 98. And no particular trend. And you can see a couple of mini bubbles there before the big one. Where I've got Greenspan on the chart, where Greenspan said the following words to Congress. A bubble does not appear likely. No, it's bleedingly obvious, you twit. Home prices declines, were they to occur, likely would not have substantial macroeconomic implications. Why does anybody listen to this guy anymore? And why do people say, if he's bad, who does he associate with? Let's not listen to them either. We need some guilt by association in this profession. But he gets away with it. And so do they. Now, the relationship between accelerating mortgage debt and house prices in America is stunningly strong. The change in real house prices, when they're going up and going down, is the acceleration and deceleration of mortgage debt. And what about Canada? You're not as bad as America, probably. Again, I'm not sure about the level of finance sector debt. This is breaking your debt down and comparing it to Australia and America. So you've got a higher level of debt than Australia, which is not a good thing, because I reckon we're going to have a bit of fun shortly. But nothing like the level of America, so long as the financial sector debt is included. But that could be different, in which case all three would be very similar to each other. And looking at the breakup of your debt, you've got a much higher level of business debt, even than America, which is intriguing. But you certainly had that explosion in mortgage debt from 20% of GDP back in 1970 to 60% now. Now, to give you some idea of the difference there, Australia went from 20% in 1990 to 90% at the same time. So you're not as exaggerated a bubble in mortgage debt as Australia is, but certainly you've had one. And of course, there'll be changes in the acceleration of debt across that whole period. So what's happened there? Well, first of all, in terms of debt, remember I showed you America went from plus 4.5 to minus 2.5 over a 2-year period? You didn't quite do it. You didn't even hit the bottom. You had to plunge in the debt contribution and a strong plunge in your GDP as well, but you didn't get to the point where the blue line crossed the red, where the American went right through the floor. So the reason you didn't have a severe downturn in America is because you didn't have as deep a deleveraging experience. In fact, you're still leveraging up. Now your debt level's growing at the same rate as GDP. So you've avoided the consequences of deleveraging, but I don't think you'll avoid them forever. Again, even though you haven't had the total deleveraging experience, that same effect of accelerating debt being a major factor in determining what happens to employment occurs with you as well. It's not as strong a negative correlation as for America. What I've done here, by the way, is I've turned unemployment upside down on the right-hand axis. So I've got unemployment being 5% up here and 15% down the bottom. And here I've got the acceleration in debt, just to make the visual correlation more obvious. But it's a lower correlation than America's. It's not as strongly debt-dominated as the American economy is. But you've still got the relationship going there, and you're still relying upon accelerating debt to keep you having unemployment at lower levels in America. And here we get the unemployment correlation for, I think that is America, actually, I put the wrong way around. That's showing the American data. You can see the much stronger impact on the American data than here. That's the wrong order, pardon me about that. Now, what about the housing bubble? Always the question I can't avoid answering these days. Well, I think yes, you have one, but it's not as extreme as America's or Australia's. This is indexing you back to the start of the only national price index you have, which again, Jim gave me the data for this. So setting them all to American, Australian housing and Canadian real house prices to 100 back in 1999 when your data began, obviously the Americans have had a bubble on its burst. Australia's got a bubble that has burst. It's taken a while. This was a period where we reboosted the bubble by a government policy I call the first home vendors boost, where they gave extra money to first home buyers so they could lever it up and give 5 times as much to the person they bought the house off. And that restarted the bubble here. But you guys had a bit of a downturn in the crisis first hit, and then you recovered again. You're now going sideways. But my guess would be you're about to start going down. Here's looking at by city, going back to 1990, a long comparison, because the city data actually is longer than the nationally aggregated data. It's back to 1990. Again, you've got a bubble ranging somewhere between where the Americans have fallen to from the peak of their bubble across the same time and the maximum level that Australia's hit across your major cities. But the same thing that's driving your house prices, as drove all the others, is mortgage acceleration. So you can see that from 2000 right through to 2009, your mortgage debt was accelerating. And that's why you had your rising house prices. Then it plunged during the first beginning of the downturn. Then it recovered again. You're back accelerating. Your house prices were driven by that phenomenon. And now, as you can see, your acceleration is heading negative again. You've still got positive house prices, but I'd lay odds they're going to go that way. And I wouldn't like to be somebody selling a condo or two next year for that reason. Is it looking at the longer term again, using that data for Vancouver? Again, showing the correlation is very powerful there. Even though I'm working at national data to city data. Montreal, same sort of story. So when you think you think you're getting money for nothing when you buy a house and its price rises, you're actually capitalising some of the debt that's been used to drive the house price up. That's what you're really doing. It's not money for nothing, it's money for being what is called a death contract mortgage. Now, you can't keep it up forever because for the last 42 years, your average rate of GDP growth has been lower than your average rate of debt growth. The black line is the average for GDP, the blue line is the average for debt, the red is the actual rate of change of debt over that time period. So at some stage, you've got to go through the same experience the Americans are going through of declining debt, and it will be down for quite some time. Now, again, I can't say for Canada as comfortably as I can for America because you need long-term data here. Here's the long-term data again for America. Ratio of debt to GDP, and what happened during the deleveraging periods. This is from the absolute peak, but that was largely due to deflation. So I prefer this line here, where there was a 9% rate of decline per annum in the debt to GDP ratio from the beginning of the Great Depression to the beginning of the post-war boom, including a little episode over here in Germany you might have all heard about. Then off goes the bubble, up you get to here. This is now extrapolating that rate of decline. Now, to get back to the level of debt you had back in 1980 would take you another 15 years, take America 15 years. So it's quite possible there could be 15 years of deleveraging ahead of us. Now, I know that sounds implausible, but imagine if I told you in 1990 that I expected Japan to go into a 2-decade-long slump. You'd have thought I was mad, wouldn't you? So don't underrate it. These things can last for a hell of a long time. So we have to get out of this dilemma. We have to stop capitalism having these regular crashes into financial brick walls. And since accelerating debt is the real source of the bubble and the real source of the crises, we have to break the nexus between accelerating debt and rising asset prices. So I've got two proposals for that. One I call Jubilee shares. And the idea is that a share would, as it does now, last for as long as the company does, if you buy it from the company, and it could be sold up to 7 times on a secondary market. That's just a biblical number. But after the 7th sale, it would last 50 years and then expire. The whole idea being, you'd be an idiot to just borrow money to buy it after the 7th sale. Any time before that, maybe. Certainly to get into the market the first time around, you might borrow money if you think you're onto a sure thing. But it would cut off the attraction of gambling on the secondary market and limit the secondary market just to the price discovery and need for people to be able to get out of things like Facebook and get into good things. Let's hope, for example, Tesla might be one of those. But reduce the extent to which leverage drives what people do on stock markets, and therefore get genuine valuation for shares rather than levered share prices. The other one I call the pill, and that stands for property income limited leverage, because banks claim they're basing the loan they'll give you for a mortgage on your income. No, they're not. They're basing it on a bubble. And back in the 1960s and 70s, if you walked into a bank with $30,000, you could have walked out of that bank with the capacity to bid $100,000 on a house, because all the bank would give you back then was a 70% loan-to-valuation ratio. Recently, if you walk into a bank with $30,000, you'd walk out with $1 million, because the ratio had gone to 97%. Is it any wonder house prices rose? Now, I want to stop that happening right at the outset by saying the maximum amount that can be levied against a house by a bank should be about 10 times, just a round figure, 10 times the property income. So if a house is going to sell, or if a house is earning, say, $25,000 a year in rent, then the maximum the bank should be able to lend against that would be $250,000. And that would then mean that if, say, Matthias and I were competing over a house, and we both had the same income and the same savings, we'd also have the same leverage, and the only way for one of us to beat the other would be to save more. So you get a negative relationship between leverage and house prices rather than the positive one that applies right now. Now, a lot of people, when they make proposals about how to reform the financial system, rely upon regulators or fine-tuning by economists, etc., etc. Does anybody believe that works after the last 40 years? No. People that get fine-tuned are the regulators by the banks once they get enough power. So you've got to stop the banks accumulating that power in the first instance and not rely upon regulators. I'd far rather rely upon judges, whatever one might think about the legal system, are damn sight harder to corrupt than the legislators are. So break that negative feedback between asset prices and the change in debt, and reserve debt as much as we can for investment and some consumption, not for Ponzi schemes. Now, of course, that's all in the best of worlds, after we got through the crisis, we have to get through the crisis as well. And as I said, if we rely upon the normal mechanisms of deleveraging, we could be in this crisis for 1.5 decades. That's if we're lucky, because looking at what they're doing in Europe, we'll probably make 2 or 3 decades worth out of it, given the mess they're making over there and the mess we're seeing in the political battle in America as well. So I call it a modern debt jubilee, but I think it's much sexier to call it quantitative easing for the public these days, given the way that Ben Bernanke's named it. And the idea would be to cancel the irresponsibly lent money without penalising savers, because there are savers in the system. So it would be an injection of government-created money into private bank accounts, where if you were in debt, your debt would be reduced by the amount of the injection. No choice about it. Couldn't decide to spend it on something else. Has to go to debt reduction. And therefore the debt that was associated with, whether it's bonds or bank debt, is necessarily paid down, which reduces the liquid assets or the money-earning assets of the banks, but gives them extra liquid assets at the same time. So it doesn't affect their solvency, but it does challenge their liquidity. Reduced bonds in value, that affects anybody who's been a saver, who's got bonds, but of course they've got a cash injection, so they can spend out of the cash injection. So hopefully doing minimal damage to aggregate demand and having a minimal impact upon inflation or deflation as a result as well. But another essential thing is to reform education in economic research, economic education and economic research, because we have to throw out the neoclassical fantasy that played a major role in letting this happen in the first place, and develop a realistic monetary economics, which is the sort of thing I talk about in the book, about to sign for some people and flog to others. Thank you very much.
I really have to run out of here quickly because I need to put my condo on the market tonight. I'm not kidding. So we have maybe half an hour for Q&A, and I'll simply go from right to left, put up your hand, and I'll try and exercise a bit of gender equity here. Well, maybe I'll go from left to right.
There's been a lot of discussion, particularly in the last 2 years, about growing income inequality in general, not only in Canada, but exaggerated in the US and Europe as well. I mean, it seems like it's a feature of modern economies.
Yeah.
What relationship do you see between income inequality and growing debt?
Yeah, there's actually, I'll give 2 answers to that question. One is Jamie Galbraith does the best work on that front. Look for a thing called the University of Texas Inequality Project, UTIP. You'll find his data on the front. Jamie argues that the usual relationship between income inequality and growth is that income inequality will rise when an economy is growing out of an underdeveloped state towards developed and then fall further on. So you get what's called the Kuznets curve, where inequality rises and then falls. But he said what's happening now is rising again on the other end. So we're seeing definitely a trend of rising inequality. To me, that's coming out of asset price speculation, because most of the wealth being made these days is out of Ponzi merchants, otherwise described as bankers, capitalising this huge amount of debt, paying themselves gigantic fees, levering up, and being the ones who gain out of the increase in debt in society. So that's a sort of empirical answer. One thing which came out of my mathematical models that I didn't expect, and Matthias has confirmed this in his own paper on my model as well, is that there's a strict causal relationship in the simulations I do between the level of debt and workers' incomes. So the level of debt and the real interest rate combined, the higher they are, the lower the workers' share of income is, even if it's not the workers who are borrowing the money at all. So my model, capitalists borrow the money, not workers. I've extended the model beyond that, but in that simple model, capitalists are the ones going into debt. They're paying it, but the dynamics of the system are such that it actually means capitalist profits remains along the same fluctuating line, wages fall. So there's a causal relationship therefore, not just an empirical thing or the behaviour of rapacious executives in banking sector, but also a causal one in the mechanics of capitalism. So in a fundamental way it means that workers, I think, have less of a class struggle with capitalists than they do with financial capitalists. One thing that Marxists often rail against the capitalist system, blah, 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 and they're really talking about industrial capital and taking it on. But if you look at the dynamics of the system, it appears that the actual ones they lose out to aren't the industrial capitalists, actually the financial capitalists. So the workers have got a real interest in restraining the growth of financial power. brighter than Ben Bernanke. Financial literacy, the main problem with financial literacy is that economists are illiterate about finance. They're mathematical about it. They've developed mathematical formula that are highly complicated and look convincing until the crisis hits. But they're the ones who are completely illiterate about it. Matthias gives a lovely little story. He wanted to tell one about the paper you gave in France and the reaction when you criticised the model point of the neoclassical. Now, you can talk about it.
I can talk about. So this was at the Sorbonne. Oh, it was at the Centre d'Economie de Sorbonne, and I was giving a talk on this model and my work on it. And at one point, I was criticizing dynamic stochastic general equilibrium, which Steve talked about, and I thought that this was going to be like a bombastic criticism. I said, you see, dynamic stochastic general equilibrium assumes that crises don't exist, and then they come from the outside, and then it re-equilibrates. And then there was this professor who works on it and said, yes, what did you want? Of course crises don't exist, and then we need to assume them.
He thought the fact that he assumed there weren't crises was the strength of his model. So the true financial illiteracy is amongst economists. And they've defined what they call financial literacy. So what they're doing in the name of financial literacy, I think, is deluding children. And I'd rather be teaching them from Hyman Minsky's point of view about it and saying what's the responsible thing about debt. Whereas what they're being encouraged to do is talk about expanding portfolios and diversifying assets, etc., etc. What we now know, this is turning up in the crisis as well, when a crash occurs in financial assets, we might try to diversify yourself against such things. When the crash occurs, all the correlations go to 1. Everything collapses. People get out of assets and liquidate and go into cash. So the advice that looked really sensible during a period of growth becomes catastrophic during a downturn. And yet that's what's defined as financial literacy by conventional thinkers on finance. So I think the kids are better off before they get to classes. I'd like to redefine the classes. I think what happens in the financial bubbles, they actually undermine a lot of the development you'd expect in the physical sector. It's a whole lot of reasons behind it, but when people think they can make 25% returns by speculating on condominiums, they're much less likely to try to develop a new form of carbon reduction technology. So the actual bias towards financial gain takes brains away from doing innovation. We actually have less engineers as a head of population now than we had back in the 1960s, and many more financial engineers. I wouldn't use consulting engineering to call them financial engineers. But the brain power's gone into speculation rather than to investment. So I think it actually diminished the extent of that type of investment. But the other side of it too is that everything turns into a speculative commodity. So it amplifies the tendency to invest in things like shale oil here and whatever you think might be the next big thing. And you get extremes and therefore probably over-investment and greater cycles coming out of it. But certainly if we had the type of philosophy that existed in America in the 1950s and 60s, continuing through for the last 40 years, I don't think we'd have anything like the same dangers we now face in global warming, for example, because the engineers would have taken that as a challenge rather than something to be ignored while they built castles in the sky.
So why can't you just sit down with Paul Cartman and through this, and you both come to a nice, happy agreement on what reality is?
That happy agreement gets him confessing that he should hand back his Nobel Prize, and what he's done for the last 40 years was a waste of time. People don't do that. I wish they would, but there's an enormous personal investment in in holding on to an orientation you've had for your whole life. And people are far more likely to deny empirical reality than they are to accept their theory, which means they were wrong. Really what you're talking about is, why doesn't somebody, if I actually suddenly show that, you know, we actually found the bones of JC, so Roman Catholicism, everything else collapses, and hey, there actually was, you know, gold tablets buried in Utah, I don't think I'd convert many Christians. You know, the capacity to stick to deny what you see because it doesn't stick with what you believe is a phenomenal part of humanity. And economists are worse on that front because they don't have the empirical prism or lens through which to filter stuff. With scientists, there's a much, much stronger marriage between theoretical work and empirical outcomes in physics than there is in economics. So, like with this large, they're looking for the Large Hadron Collider research they're doing right now, where they're trying to find the Higgs boson. If they don't find it, then they'll be absolute. We must be wrong. What on earth's happened in physics? It'll be an incredible period of soul searching. You know, we thought the Higgs boson was there, but our explanation for gravity is now sunk. We've got to find it'll be enormous. It's challenging. Economists have sailed through the biggest financial crisis without even blinking and still preach the same shit, pardon the French, to their students. And I know because I see their classes. So I wish Paul Krugman could admit he was wrong, but he's actually just come out a couple of days ago saying that this period is a triumph for conventional economics. One of his blog posts, he says how ISLM analysis, which is what one of the versions he practices, coming from a guy called John Hicks, has been a triumph, but that advises we should actually have an increase in spending during the downturn, whereas the other ones, he only recognises Chicago versus New York type economists. The other type are arguing for austerity. Well, he hasn't read even John Hicks on the front. The guy who invented that model threw it out in 1981, said it was garbage. And here's Krugman saying it's a bastion of wisdom and it shows how it works. If it shows how it works, then ISLM should have predicted the crisis. But it can't because it's an equilibrium model. Crises don't happen when you're in equilibrium. So there's this capacity to deny reality, and they will continue denying reality until one of us and another five are walking down a similar building with them on our shoulders.
You're not suggesting it. If you're debt to the lead, is there any concern in your report about moral hazard for the debt?
Well, that's why I want to eliminate the possibility of speculative gains later. If you actually did what I'm like with the debt jubilee without also reforming financial assets, then you could have that sort of moral hazard happening. But bear in mind, we're talking about moral hazard after the biggest period of collective immorality in human history, where the people who are arguing that we should make sure debtors pay what they get into were the ones who were immoral in the first place by lending the way they did. It isn't, we tend to take the blame. It's a bit of a Stockholm syndrome where the debtors think, oh, we shouldn't have borrowed that money, it was our fault. But a lot of the money, particularly in America, was lent to Mar and Pa Kettle in the south of America, you know, with an IQ lower than their, whatever. And if they're on the other side, they've got, you know, a bank with 500 PhDs saying, yes, you can afford this money. Yes, this is a good idea. Borrow and join the American dream. So the irresponsibility in terms of skill definitely lay on the side of the lenders rather than the borrowers. It wasn't the borrowers sucking it out, but the lenders pumping it out. And the other thing I want you to think about too, which is a little legal detail that intrigues me. Who's the buyer in a mortgage contract? Who's the buyer? Somebody's selling, somebody's buying. Who's the buyer? Who's the seller? Any idea?
The borrower is the buyer.
The borrower's buying. That's the usual attitude. The borrower's buying something from the bank. No, they're not. The bank's buying from the borrower. Because the bank is buying a promise from somebody to pay them money indefinitely into the future in return for money now. Okay? So it's the bank buying a promise for the future. So the bank's the buyer. And it even turns up in our language when we talk about it when it goes bad, because when it goes bad, we talk about a mortgagee sale. The Latin root of that means buyer. Mortgagor is the seller. Now, if we imposed caveat emptor, another lovely Latin term, buyer beware, on contracts like that, if a bank lent to somebody who couldn't afford to repay them, you take a look and say, okay, so you lent Jim Stanford $10 million to buy this house when he earns $100,000 a year, and you want us to believe you did this seriously, you're going to shop that badly, tough luck, Jim keeps the house, get out of here.
Somebody back there, right? Yeah.
Can you say a bit more about how you factor in long-term trends in sovereign and non-sovereign default?
Yeah. There's another group, there's what's actually happening next week, that Matthias mentioned, is a group of people who belong to a school, a sub-school of post-Keynesian thought that call themselves modern monetary theory, and myself and Michael Hudson are getting together to nut out whether we can try to bring our views together. Because the modern monetary theory crowd argues that effectively any crisis can be solved by a large enough level of government deficit. Whereas my perspective is, well, no, you have to also take account of private debt. And yes, I'm in favour of running a deficit, but I would also want to reduce private debt directly at the same time. Now that's now, I saw a post by Randy Badidow saying precisely that as part of that group. So there's some coalition going on. But we still have to thrash out the theory of this, but my argument is that they say that the private sector deficit, savings is equal to the government deficit. So if the private sector wants to save, the government has to run a deficit. Now I'm arguing that mathematically we've left out the capacity of the private sector to expand debt levels independent of what the government does. So therefore I don't agree with their strict causal link. So I think they're about 30% to 50% right. And you certainly need to run deficits when the private sector is deleveraging. But that in itself won't solve the problem. You've got to also address the level of private debt. And that's why I think Japan's been stuck in that funk it's been in for 2 decades now, because the government's run continual deficits while the private sector's only slowly delevered, and the impact has been a stalemate. What you've got to really do is drive that private debt level down as well. Yeah.
So I of course like your idea of the Jubilee shares and Hill, but they address a notification mechanism that rides what's already an increase in debt. And if people cannot speculate in shares or houses, they speculate on Rolex watches or paintings or something else. But the source of the instability, as Keynes and Minskian would point, is the mechanism of investment and the relationship with capital. So correct me if I'm wrong, but Keynes would suggest that you have to sort of socialize investment. And Minskian would say that you need to move to less capital-intensive forms of investment, and that relates to the way of consumption and so on.
Yeah,
What's your view on that?
I don't mind people gambling on Rolex watches, because the bank won't lend them $1 million to buy a $100,000 Rolex watch.
Yeah.
So you don't have the same danger of levels of leverage going on there. And if anybody goes bust gambling on an old painting, then they go bust, tough shit. You know, you don't worry about that. So, pardon. Don't give me why I give it for a talk, okay? But that's the reason I wouldn't be too worried about the level of speculation. I think actually we've got to go towards more capital intensive over time, but what we have to socialise is not the investment, but the wealth coming out of it, because it is ridiculous that we've got to the level of technology we have now, and we're approaching the stage where you can have fully automated factories, where if that happens, the working class is unemployed. And you really need to break the nexus ultimately between income and employment. So I think that's what's necessary at some stage, because we're surely converging on the stage where production, once can actually be done without labour. Have you seen 3D printers yet? I'm going to buy one. They actually can print 3D objects, and now they're getting to the stage you can print them with multiple components. You'd actually make a very, very complicated multi-layered object with a machine, with zero labour input. That sort of thing I think is going to be, mean that we actually get to the stage of that being universal, then we have to spread the ownership of capital resources and income from them. Yeah.
You don't even have to buy one. You can make one yourself through open source or technology. You can Google it.
Okay. Make a 3D printer.
Yeah, you can.
Make your own 3D printer.
Yeah, you buy these Arduinos, you get 3 of them, and it's online, and you can basically download the instructions, and it will work. Yeah, I've seen it.
You've got to buy the parts, I imagine.
Yeah.
You can't make it. We'll talk over drinks. Yeah.
Assuming her don't implement Jubilee policy and instead therefore house prices are going to come
the simplest thing is get out of debt. You know, if you're in debt, then when the downturn hits, your cash flow has to service that debt. And if you're hanging on an asset which is falling in value at the same time, you're losing twice, both out of servicing cost and losing capital value. So the best thing you can do is be liquid. If you have a secured source of income and a very little of debt, then don't bother. Just carry on as usual. But if you are in a job where you might think it's vulnerable to a downturn and you're carrying a large mortgage, then your best situation is to get out of debt. And of course, this is why you can't just do it at an individual level, because if you do, it causes the cascade you're trying to avoid. So the other thing, you really have to get together in groups like the Progressive Economics Forum and so on and lobby for political change, because do it at the individual level alone, it'll be one of those many factors in capitalism where doing the best for the individual causes a crisis for society.
One more, okay? And then we have to...
If the Fed in the States and the central banks around the world they start to rate inflation to easy to prevent the inflation, that won't work.
Well, again, it comes back to the way money is created. Their theory is if they pump in extra reserves, that'll mean that 10 times as much money is created. And Obama actually made that speech in his 2009 inauguration speech. He said, people ask me, why am I bailing out the banks? Where's my bailout, they ask, a classic Obama line. He says, it's because the dollar given to banks generates $8 to $10 in additional, and he actually used the word, loaned money, a multiplier effect that gives us more bang for our buck effectively. That's, again, pardon the French, bullshit. It's, again, that same nonsense neoclassical theory about how money is created. So when you actually put the money into reserves, and I've modelled this in a proper dynamic model, it's about 1/3 as effective as giving the money to the public instead. So what they're doing is ineffective. If you actually wanted to do what they're doing effectively, you'd actually do quantitative easing to the public, as I'm suggesting, without the thing about debt. That could potentially cause inflation. That could remonetize. But what they're doing is the most ineffective way possible of trying to achieve what they're trying to achieve.
Okay, now really we must go and drink. And maybe drink a lot after tonight. But I encourage everybody to retreat to the bar. We have wine, we have cheese, plenty of opportunity to mingle and speak with Steve and pose your question. You can have an opportunity